Another day, another headline about record gold and silver prices. Check out this headline that just appeared on CNBC today. With silver prices up over 130% and gold prices up nearly 70% year to date, investors are right to wonder, can this rally in precious metals continue, or are we increasingly likely to see a near-term pullback in prices? The answer to both of these questions is quite possibly and probably yes. It all comes down to time frame, risk tolerance, and position sizing within a properly diversified portfolio. The world's central banks have spoken pretty loudly about the role of gold in a portfolio. In the World Gold Council's 2025 Central Bank Survey, they found over 70% of the world's central banks anticipate increasing their allocation to gold in their reserves holdings over the coming 5 years. The same survey also found that over 70% of the world's central banks anticipate decreasing their allocation to US dollars in their reserves strategy over the same 5-year period. A multitude of reasons were given for why gold serves an important role in central bank reserves, including performance during times of crises, concern about purchasing power, and also concern about counterparty risk in an increasingly fragile and interconnected modern global financial system. These are very much the same reasons we and our clients have valued precious metals as an important asset class in their portfolios. But with the recent rise, I urge people to take a look at making sure their position sizing hasn't gotten too large. For many, it may likely have, so now's a great time to sell and take some chips off the table. For those that haven't had allocation to precious metals, it's not too late. We think just a properly conservative and stepwise approach to this is what's warranted, because it is, we think, an important part of a properly diversified portfolio. On the topic of broader portfolio positioning, with the recent years' strength in the stock market since 2022, many investors have become unknowingly overly risky in their portfolios. For example, the investment firm Apollo just did a study that postulated that a 60-40 investor, a 60% stock, 40% bond investor in 2019, if they just held that portfolio passively since then, they'd be at closer to an 80% stock, 20% bond allocation. This is at a time when the US stock market anyways is at record high valuations, eclipsing even the tech bubble peak of 2000 and the 1929 peak right before the Great Depression. So now's a great time for folks to take a good hard look at their portfolio positioning and in many cases choose to de-risk and make sure that your portfolio is properly aligned with the risk environment in the markets, but also, and most importantly, your goals and objectives for secure retirement.